RLAY Therapeutics is focused on a specific challenge in oncology, targeting PI3K alpha mutated breast cancer cells while leaving healthy tissue untouched. Their lead asset, RLY 2608, is designed as a pan-mutant selective inhibitor to achieve this precision. This medical focus has been paired with a recent financial pivot. By reducing R&D and administrative costs, management extended the company's cash runway into 2029, pulling the stock back from a 2025 low of $2.46. Following an FDA breakthrough designation and positive clinical data, the stock climbed from $8 to a peak of $15.89. But on April 14th, a hold rating immediately dropped the price to a daily low of $14.75. This creates a divergence for investors. You have to determine if this dip is a signal of a cooling market or if it's a temporary pause in a larger institutional accumulation. To understand the price movement, we have to look at the float, the actual number of shares available for public trading. RLAY has a highly unusual ownership structure. As of April 2026, institutional giants and company insiders lock up 98% of the shares. That leaves an available float of just 2% for everyone else. The shares are concentrated in the hands of major power players, including SoftBank, Commodore Capital, Point72, BlackRock, and Vanguard. This creates a zero-float environment. Because almost every share is already spoken for by institutions, the retail market is operating in an extremely thin pool of liquidity. In a market this tight, even standard analyst reports can cause disproportionate price swings. When there are very few shares available to buy or sell, any increase in volume leads to rapid, jagged movements in the chart. The volatility we saw following the recent rating is a mechanical result of this low supply. It reflects the structure of the market more than the health of the company's underlying science. The April report itself contains a notable gap, a hold rating paired with an $18 target price. That target represents an 18% upside from the price at the time of the report. While analysts often use hold ratings for risk management or regulatory reasons, in a low-float stock like this, such a label often functions as an algorithmic trigger. Automated trading systems are programmed to react to the hold ceiling. Just as the stock reaches a new high, the automated selling creates downward pressure that stops the momentum and pushes the price into a temporary valley. This environment allows institutions to act as sponges. While the price is suppressed by algorithmic selling, larger players can use the dip to continue absorbing the few remaining retail shares before the next major clinical readout. This illustrates the pressure retail investors face when trading in sectors dominated by massive institutional holdings. You are often trading against the mechanics of the market itself. For those looking at a short-term swing, the strategy involves a precision exit. If the stock pushes back $15, you move to cash to secure the gains made from earlier entries. This locks in profit and protects your capital from the compression caused by the recent analyst noise.
The next step is watching the sponge zone. This is the range between 1440 and 1470, where institutions are likely to park the stock to complete their accumulation. Re-entering in this zone allows you to maintain your position with a lower cost basis, positioning yourself for the next catalyst. However, this requires constant monitoring. You have to be ready to execute trades at precise levels during the trading day to stay ahead of the automated volatility. There is also the significant risk of buyout chatter. Rumors involving Novartis or Roche have circulated as the company's data has improved. If a buyout is announced while you are out of the stock waiting for a dip, the price could instantly jump to $18 or higher, leaving you unable to re-enter at a profitable level. Playing the sponge zone can increase your short-term efficiency, but it carries the risk of missing the primary move if a major corporate event happens overnight. The alternative is the fundamentalist approach, ignoring the daily chart and focusing on the Phase 3 Rediscover 2 trial results and the cash runway that lasts for years. In this scenario, you anchor your decision to the drug's clinical performance and the $18 consensus target, rather than reacting to short-term ratings. By holding through the noise, you remove the stress of trying to time movements that are driven by algorithms rather than medical data. The trade-off is that you must be willing to see the value of your position fluctuate and endure periods where the price is held down by technical factors. Holding firm ensures you are present for the full potential of a buyout premium or positive Phase 3 data, making the current market fluctuations irrelevant to your long-term outcome. The decision comes down to a trade-off. Prioritize protecting recent gains or the potential of the long-term clinical thesis. The left path is the active retail trader for those monitoring intraday charts and comfortable with frequent trading risks. This path is designed to capitalize on how institutional money moves through a low-float stock. The right path is for the biotech fundamentalist. This investor has high patience for clinical timelines and a lower desire to manage daily price swings. This approach is best if your original reason for buying was the strength of the breast cancer data and the likelihood of a strategic acquisition. The most common way to underperform is to use a strategy that works against your goals, trying to day trade a company you believe in long-term, or holding a swing trade through a clinical event you don't fully understand. Identifying which persona fits your situation allows you to process conflicting market signals without losing sight of your plan. The recent dip is a mechanical result of how this specific market is structured, not a sign that the underlying medical technology has failed. Before you make your next move, define your timeline clearly. Are you trading daily volatility or long-term clinical progress? Institutional investors use retail uncertainty to complete their own positions. Remember, in a stock with almost no available retail float, letting a technical price drop dictate your long-term strategy is the specific mechanic that often leads to retail participants being shaken out. Know your path and stay focused on the data.